According to one key technical analysis indicator, there is a raging Bitcoin bull market ahead. And so in this video, we're going to look at if this is in fact true, and also what does this mean for Bitcoin, and what does it mean for you as a Bitcoin holder going forward. Today's episode is sponsored by Cake Wallet, where you can send, receive, and even exchange your crypto right from within the wallet. Cake Wallet is open source and non-custodial, so you control your own private keys, available today on iOS, macOS, Android, and Linux. And StealthEX, a privacy-centric crypto exchange which enables you to make crypto-to-crypto exchanges anonymously. Good evening everybody, and a warm welcome back to Enter Crypto with me, Chris Kenyon, and this is the channel where every single day I keep you updated and fully informed on all the goings on in the cryptoverse. If that sounds like something you'd be interested in, then like, subscribe, and click on that notification bell so that you don't miss out on any future updates. Now today we're going to be talking about an article I found in CoinDesk. It's in their market section, and they have basically noticed that Bitcoin's RSI has crossed above 70, and this basically indicates a strengthening of upward momentum. Now, as always, guys, we're going to read through the article quickly and then we'll comment after. So the Bitcoin bull move could soon run wild, bringing a steep multi-week uptrend in the leading cryptocurrency. That's the message from Bitcoin's 14-week Relative Strength Index, or RSI, a momentum indicator used to measure the speed and change of price movements. The indicator has crossed above 70, which is a threshold that marks the fear of missing out phases of the mid-2019 and late 2020 bull runs. These FOMO phases are characterized by both retail and savvy traders pouring money into an already trending asset in fear of missing out on a significant opportunity. Developed by J. Wells Wilder, the RSI measures the speed and change of price movements and oscillates between 0 and 100. The default period for calculating RSI is 14 days, but traders use 14-week and 14-month RSIs to gauge long-term momentum. A reading above 70 is often erroneously taken to represent overbought conditions and a sign of an impending bearish reversal. However, per technical analysis textbooks, an above 70 RSI, especially on longer duration charts, suggests bullish momentum is strong and the asset could continue to rally in the weeks ahead, similar to what happened in 2019 and 2020. To paraphrase a Wall Street saying, indicators can stay overbought longer than bears can stay solvent. And it's true. You know, I use the RSI not just for Bitcoin, you can use it on any chart you like. And it can be very useful. It's really good, as the article says, in telling you just sort of how, or giving you a picture really. A chart's trying to give you a picture. And the RSI gives you an idea of just sort of the measure of the volatility, because it tells you not just if it's gone up or down, but how quick. And that can be a good measure sometimes of people's emotions. You know, people like to jump in, as the article says, for fear of missing out. And that can be through greed, if they think something's going to go up or it's already gone up, and so they jump more. You know, more people jump in, and they're not doing real technical analysis. They're just jumping in because it's they think it's just going to keep going up. And then you've got the other type is obviously the fear associated with it, and this can be on the oversold side of the RSI indicator, which is basically where people just FOMO sell. You know, they just sell because they're scared they're going to lose money. So there's a fear of losing money and a fear of missing out, downside and upside respectively. And as a trader or as an investor, or just, I mean, anybody just buying crypto or buying any commodity, asset, currency, foreign exchange, you know, whatever it is that you're into, don't be in either camp. Don't be buying anything because you're worried of missing out. The price will always come down again later in the short term. You'll always get a better opportunity. Very, very rarely does it just, an opportunity is missed and it's never come back again in finance and in trading. Now, you may have to be very patient, but there's some correction somewhere. There's always a better price point you can enter. And likewise on the selling side as well, you don't want to be selling because you think you're going to lose money. Make the decision before you put the trade on, or before you buy the asset, if it's a spot asset that you're buying, that it could go down. You know, set your stops wherever you feel comfortable in, and think about what you're doing before you do it. You know, try not to use your heart, try not to get emotionally involved, because that's really dangerous. before you put any trade on or before you buy any asset, you want to be doing lots of research and lots of homework. You want to be bringing up all the charts that you can find, using all the indicators that you feel comfortable using and that help you personally, because not every indicator helps every person. Some people don't interpret the data very well, but they might find that another indicator works really well for them. And so I suppose what I'm saying is just make sure when you put trades on that it's data driven. The decision is done by data. And also a really important thing, which is more for sort of investors than in trading, is have a low time preference. Think really long term, so that if the price goes down tomorrow, you don't care. If you believe that Bitcoin one day is going to hit $1 million, and you don't know if that's going to be in the next 5 years or 10 years, but you're willing to wait, then who cares if it goes down to 10k tomorrow? It doesn't matter. You're not going to be phased, so you can manage your stress. You can manage your own sort of stress levels by just by having a long-term outlook. Just by zooming out and treating the situation like that can just alone reduce stress levels. And it shouldn't ever be stressful. I mean, I remember when I first started trading, I was very stressed. But it's trading, it slowly turns into investing over time and over years as you spend time in the market. And one last thing, another really good trick to do is to pretend to put trades on. I know eToro and there's other exchanges, I think Binance maybe, I'm not sure, I don't use them anymore, but when I first started, I used to put basically fake trades. So I would write down on a piece of paper what trade, if I'd have had the money, what I would have put it on. And I would work out whether I would have made money or whether I would have lost money. And I would try to learn a lesson as if I'd lost money, if that's what had happened. And if I had made profit, when would I come out and when would I leave the trade? And that'll help you understand. It's not the same as losing, actually losing money, because you'll really learn valuable lessons from, having skin in the game, as they say. Actually losing money will teach you. You'll definitely not want to repeat that. Whereas if you're trading on, sort of fake trades, as I've just described, and pretending, you're not going to learn as valuable a lesson, but it's still really good to understand just basically how easy you can get it wrong. And that if that had been real money, you'd have been seriously out of pocket. So as always, guys, thank you for watching. Thank you for listening. I apologise for not having any videos up the last couple of days. I've just been busy with things at home, but I'll be uploading every day from now onwards. Don't forget also to like, subscribe, comment, and click on that notifications bell as well. And I'll see you all tomorrow. Take care.